And we're back. It's time for my favorite segment. Can we all just get along? Despite the fact that the S&P dropped 8.5% earlier this week, there may not be a cause for alarm. What is the stock market telling us with its drop over the last several days? In all likelihood, not much of anything. Let's dive in and find out what the drop meant and whether there's truly trouble in our economy. So here is what we know. We know that the Dow, or the S&P 500 and the Dow, everything dropped this week. But let's be very real. The stock market isn't the economy. Period. Full stop. Let's not move any forward. Let's not move any further, rather. Because the stock market doesn't tell us, I mean, yes, if the stock market were to crash, people are like, oh, the stock market crashes. But usually, the stock market crash is built off of something. Something happens, and the market crashes. So here's what we know. All of the indicators in the market currently are positive. You have almost full employment. We're almost at 4.4%, which is what you call full employment per most economists. Right? You see the most recent job numbers show a slight uptick in wages. Okay? And on top of all of that, all the other indicators show positive growth in the right direction. Okay? You see more people are going back to work, more homes are being built, consumer confidence is high, consumer spending is high. All positives. So you're asking me, Richard, how did the stock market fall? Well, a couple things. One, for the past almost decade, the Federal Reserve Bank has been pumping money into the economy to the tune of $4 trillion. And you're like, Richard, how are they pumping money in the economy? They're pumping money in the economy by keeping the interest rate low, by keeping the interest rate on Federal Reserve, on federal money, on the currency low, on bonds low. And by keeping the currency low, they're injecting more money into the economy. Right? They're basically taking a needle and they're just pushing money into the economy to the tune of $4 billion. So it's been easy to get money, right? It's been easy to borrow money. And if it's easy to borrow money and it's easy to get money, Wall Street loves it. They love it. But here's where we are now. Now that we're close to full employment, now that you see wages start to uptick, now that consumer spending is high, you have a problem, a likely problem on the horizon. That problem is called inflation. Inflation happens when the cost of goods and services go up. And as the cost of goods and services go up, we get an inflation economy. It becomes an like Jimmy Carter had stagflation. You had a stagnant economy, and then you also had ridiculous inflation. Other indicators signal that there might be trouble. All right, like the oil prices. Instead, point to a steady, she goes, economy. So like the other indicators, we look for oil. Oil will be a reason. If oil prices were to spike, a ridiculous spike in oil prices, America, would cause, the world to sort of panic. But that is not happening. Oil prices have stayed steady. So inflation seems to be one of the reasons as to why the market seems to be making some corrections. So I wouldn't call this a dip. I would more say this is a correction. The market is saying we've moved a little quickly, and now we need to correct ourselves, because if we don't correct ourselves, we could have some trouble. Let's look at the bond market. The bond market is not a flash warning of economic weakness, even in the midst of the stock downturn. Because what you're seeing is on the bond market, on the 10-year Treasury bond yield, the interest rate has gone up a little bit. And the reason why the interest rate has gone up, like I said, is because that is sort of the basis for inflation. Because that is the basis of how the Federal Reserve is dealing with America's money supply. Here's what's missing from this whole equation. Right? So we have fiscal policy, we have monetary policy coming from the Federal Reserve banks, but we don't have any fiscal policy. We don't have any laws being passed pushing money into our economy or slowing economic growth. So you don't see infrastructure spending. You don't see anything that's really creating real, lasting produce or goods in this country. So this brings us to the politics of this stock market downturn. Remember President Trump, ever since he's been president, has been toting the stock market. over and over and over again. Here's what he tweeted on January 20th, 2018. Unprecedented success for our country in so many ways since the election. Record stock market, strong on military, crime, border, and ISIS, judicial strength and numbers, lowest unemployment for women and all, massive tax cuts, end of individual mandate, and so much more. Big 2018. So this president has basically pegged himself to the stock market. Here's what Jay Carney said in response to the president's tweet. Good time to recall that in previous administrations, we never boasted about the stock market, even though the Dow more than doubled under Obama's watch, because we knew two things. One, the stock market is not the economy. And two, if you claim the rise, you own the fall. And Jay Carney is absolutely right. So if you notice, this president hasn't been talking much about the stock market because he's a little embarrassed. And he's like, I don't understand. He did tweet about the stock market today, talking about, I don't understand why the stock market is going down. All the indicators are good. But that's why the stock market is going down, Mr. President. Because all the indicators are good, it seems as though we are on a slow car ride towards inflation. Because everything is doing well, consumer confidence is high, so what you're going to see is an uptick in prices. And if you see an uptick in prices, without the same uptick in wages, you have what we like to call, even if you see an uptick in wages, uptick in prices, you have what we like to call inflation. The price of bread goes from $1 to $4. That's what you call inflation. And we're trying to avoid that. So here's the news for you. If you are an amateur buyer on the market, don't get nervous. Don't sell all your stocks. That's a bad thing to do. What you should be doing now is buying like hell. Buy, buy, but don't borrow to buy. But if you have some money sitting around under your mattress, take it out, open an E-Trade account, and buy like hell. Because the market is going to go back up. And if you buy now, you will only benefit later. Because if you look at it, I mean, I think this is interesting. I think Neil Cavuto on Fox News says this. He says he has a graph, and it's true, I've seen it, in his office. And it's a graph of the stock market. And from far away, it looks like it's just an upward sloping line until you get closer. The closer you get to it, then you see all the dips. You see the stock market crash, you see the Great Depression in there. As you get a little closer, then you see the 1980s stock market dip. Then you see the 9/11 dip. But from far away, all you see is an uptick in the market because the market is generally going up. Value is being added to the market on a daily basis. But that doesn't mean that value is being added to the economy, because what's happening in the economy is the cost of healthcare is going through the roof. The cost of prescription drugs are going through the roof. The rent is going through the roof. These are the items. These necessary goods, the price of them going up and the shortage of these goods, America, is what leads us to inflation. So pay attention. But don't believe the hype on this market business, because the hype is wrong. The market is not doing as bad as you think it is. It's actually doing rather well. And it's not doing well. I mean, I know, yes, some of it is, there is some confidence in the market thanks to President Trump and his tax cuts. So corporations are very happy. But remember, employment, like I said on last week's show, is a lagging indicator. It lags behind economic policy. Okay? So just because you see employment going up doesn't mean it happened because Trump became president last year. It could be because of Obama policies 3 years ago. It lags. That's what you need to remember.